Greetings to all of you and welcome to this event on financing from the private sector for Africa, both in the near term and looking forward. And I'm really very happy that we have this particular conversation today because these days there are many conversations on financing for development and financing for Africa and financing from the private sector. And we thought that it would be useful to try and focus a little bit and have a conversation that really looks at what are the prospects and impediments to financing from the private sector for African development, both looking at the near term and in the longer term. And we have, particularly we're happy here at the Center for Global Development that we're hosting this conversation with the Economic Commission for Africa, the ECA, and we have with us Vera Songwe, who is the Executive Secretary for the ECA, and I'll turn to Vera in a minute to give her perspective before we bring in our three distinguished private sector panelists. And we have Tijani Thiam, who has, of course, Tijani can come into any conversation as a private sector panelist or as a public sector panelist because he's had such a distinguished career spanning both the private and public sectors and brings really an enormous wealth of experience and insights, and really very happy that you're with us today and look forward to your comments. We have Chiedza Matsiba, who is with Fitch Solutions, and I think the perspective that Chiedza you're going to bring, if I understand correctly, is really looking at, again, a little bit the longer term prospects for private financing, for what role the private sector can play in supporting development in Africa, and what are the risks and how to overcome some of these risks. So very much looking forward to that. And Charles Robertson, who has a very nice virtual background that already tells you where he's affiliated with, which is Renaissance Capital, is really a name that is so well known to anybody who follows trends of private financing in Africa and low-income countries. And Charles, you'll be able to, I hope, give us a little bit of a perspective of not just sort of near term, but again, longer term. And during this conversation, we will have also Ken Ofori-Atta, who is the Minister for Finance in Ghana, but also he is the chair of the Development Committee, which, of course, as most of the viewers will know, is the ministerial committee that oversees the work of the World Bank and the IMF on development issues. It's a joint committee of the two. He's also chair of the G20, the African caucus this year. So in many ways, he is bringing together the perspective of developing countries. And I think Ken is joining us, has joined us, or is making the connection now. So perhaps when I've just turned over to Vera, what might be best is to really start with his perspective and listen a bit to his sense of where things stand. How far have we actually come now, more than 6 months into this pandemic, and 5 or 6 months after the first set of big statements about how important it was for the world to come together to help Africa. Here we are approaching middle of September. We're coming up to the UN General Assembly meetings on finance for development, and then to the World Bank IMF annual meetings coming up in a few more weeks in October. And I think Ken would be the best person to give us a sense of where actually do things stand on the ground, and what can we look forward to. So that's a little bit the plan for this hour. Let me now turn to Vera and get her perspective, and then we'll turn to Minister Ofori-Atta. So Vera, over to you.
Thank you so very much, Masood and the CGD for co-hosting this event with us. I think we just wanted to, we've been talking so much about the private sector and what the private sector has done in this crisis. And so we thought, let's get a very different view of the private sector, not necessarily, you know, the markets or the Eurobonds, and just get a different sense of what is it that we expect to do with the private sector differently on the other side of the crisis. I think that we're going to need you even more as we go to the other side. I think looking at the US market this morning, unemployment still at 25 million. Some jobs are recovering. I think there's been a less than expected recovery of the job market in the US, but still I think quite robust considering everything that's happening. We need the same on the continent. We need even more. And so the question is, what do we need to do together to get there? Yes, in the sort of immediate future, we need more resources. We need additional resources to stand up the public sector and liquidity. But I think as we go forward, really the question will be, how do we redesign a new relationship on the continent with the private sector to ensure that when this happens again, we can do it differently. I mean, I see Tijan from, you know, they're the big money market people. You know, how can Africa get access? Everybody keeps talking about trillions. I'm on a different meeting with Kristalina telling me about blanketing the economies with trillions. I'm thinking, well, Africa didn't see those trillions being blanketed on our economy. How can we do that differently so that Africa gets access to that? I think really that's the conversation that we would like to hear today. A different perspective, not the rating agencies, not the big markets, but, you know, a perspective of, I think, you guys who are working with us day to day and how we design a new private sector for Africa with our policies and ensuring that global policies, even at the BIS and all that, take into account that Africa is now emerging and needs to have a seat at the table. And so once again, thank you so much for coming together to have this conversation with us, and look forward to an interesting conversation.
Thank you very much, Vera, and thanks again for co-hosting this event with us. Now, I do see on my screen that Ken's office is online, and I think Minister Ofori-Atta is probably just about to come in and join us. It'd be nice to start with him if indeed he is just coming on now. Let me just, and if not, we will, what we could do is then get started and have him join us. Vera, I was just wondering, while we're waiting for Ken to come, maybe I want, and there's Ken Ofori-Atta just sitting there. I was going to ask you, Vera, to give a little bit of a sense of what was the mood in the African Ministers of Finance Forum, but in terms of their thinking about what one can expect. But since the ministers is himself going to be here, we might get it directly from Ken, and I think that was just
I think that's the mood of the African finance ministers. They're coming and going. They're not yet sure what the world wants to do with them.
Minister, how are you, sir? Very nice to see you. We've just been talking a little bit while we were waiting for you to.
I had Vera holding my name in vain, but you know.
So we were listening. We were talking a little bit. The role of the private sector.
Yeah. Hi guys, Charles and Chidza, how are you?
Everybody is. So we thought the best thing to do really in this conversation was to start with you, not to put you on the spot, but you're so used to it that I don't feel bad about it anymore, putting you on the spot, because really I want to get a little bit of a sense that here we are, sort of 6 months after the initial meetings that were saying how important it was for the world to come together, provide support, and then there was this DSSI and the debt service suspension initiative on the official side, some exhortations to the private sector to join in. As far as I can see so far, those are mostly exhortations. I don't really see that there's been a sort of wholesale joining by the private sector. And also it seems that many of the countries in Africa are not very keen to actually bring the private sector into a debt service suspension initiative, because they're more concerned about their longer term access to private finance and what this might do to it. So before we get into our private sector panelists, Minister, I thought it'd be great to get your sense of where do we now stand in terms of the financing picture for Africa near term and dealing with some of the impediments that have been put on the table? And what would you like to see from the private sector going forward? And then we would be able to bring our private sector panelists into the conversation. So could I turn to you for a quick overview on your sense of it?
Right. Masood, thank you very much indeed for this opportunity. Let me start with, this quotation from MLK. We will remember not the words of our enemies, but the deafening silence of our friends. and really, I have looked with a certain amount of confusion and anxiety over the 6 months that in truth, we have not done much. And that is if you juxtapose it to, let's say, the financial crisis, in which I guess some new SDRs or a trillion was able to be unlocked by Gordon Brown, and juxtapose that to what is happening on the continent with no toolkit at all with regards to the 11, 12 or trillion that the developed countries have been able to do, and necessarily so for lives and livelihoods, and to really pump up economic recovery. I think that's fair, and they should do that. But then you see a certain degree of normalizing of discussions and talking about moral hazards and debt levels and there's a real sense of exasperation, sort of working on this financial architecture which has such unconscious biases and rigged, and it's on that basis that Africa is expected to then meet its the demands that are pushed on that. So where then is the whole issue of humanity and creating a much more fit for purpose architecture for the future? And you don't see a coalition of minds, sitting down to really interrogate that. And so, for example, if you look at the DSSI, great intervention, clearly on a liquidity basis, very effective, but it doesn't take any rocket scientist to realize that this is not a pass and frigate, but it really is a 3-year scheme. So kicking the can up the street to even think 6 months is almost ridiculous. To then sound generous by adding another year is also, playing on the margins. A global public bad, as Vera would like to say, being approached in a siloed function that is not going to lead to a resolution to Africa's problem, and for a continent that is continually going to be relevant. And by the time we get to 2050, we have a quarter of the world's population, the largest youth, and all of these resources of the world. So it is even in enlightened self-interest for us to really recalibrate and take this, very seriously. So yes, I keep wondering again why Africa falls into these malaises, and there's no one there to support us. And the private sector, as you know, has been very absent in all of this, and even some of those who dared to take the DSSI have been slapped on the wrist by the rating agencies. Then you have this duel between the US on the SDRs and China on the other hand, and you are caught in this ridiculous fight when 30 million people likely are going to go into sort of extreme poverty, 100 million jobs are at risk, and 80 million former jobs. So Masood, that's the what is before us, and I think we honestly need to do much more, and how to trigger that is what we need to find a way to do that, to bring the consciousness and awareness and ownership to finding a sustained solution to that. So thank you for this opportunity.
Thank you very much, Ken. You know, you and I had a conversation, I think now about, I'm thinking 4 months ago. And you were more optimistic 4 months ago than I hear you today in terms of your assessment of the situation. And I guess at that time it was ahead of us, and one could afford to be optimistic. And now here we are 6 months into it, and it's really, the conversation is, how do we change the trajectory that we have been on for 6 months? Because the 6 month trajectory really is a conversation that is largely focused, as you said, on sort of, you know, the DSSI, which itself has, on the private side at least, not seen much participation, but also in terms of scaling up volumes of funding, you know, we are still struggling. So I think that it would be good now to drill down a little bit on the sort of private part of this. And I wanted to turn to Charles, if I may, first on this, which is, you know, Charles, what the minister was saying was very much around, so the private sector has been absent from the conversation about debt relief. And before we started, you were actually saying that was a misguided conversation. I mean, not to put words in your mouth, but in a way that it would be better to focus on the potential for private financing beyond the crisis, rather than on the sort of this debt relief for the private sector, which could be an impediment to getting that financing. So I want to get a little bit your sense. What is your advice to the public sector? Is it to say, stop focusing on trying to get a few private sector creditors to participate in this debt relief initiative and focus on the longer term? Is that feasible? What is your take on all of this? And how optimistic are you about where this could lead to?
When this began, February, March, I was a strong proponent that the West, particularly the G7, should be borrowing as much as they possibly could, let's say $100 billion, probably paying 0% interest on that and lending it to Africa straight away, 5% of GDP, just as a signal of, and it could be lent because it would be basically cost-free. There'd be no interest cost to Africa. When that didn't happen, because the G7 finance ministers just didn't get it together or didn't care, it felt like there was a fallback to what could be done. And the DSSI was an interesting idea. But the idea of bailing in the private sector, I think, is dangerously counterproductive. Because what the message it's telling global investors is, the next time a crisis comes, invest in the West, invest in Google, buy tech stocks, buy the S&P, because the Fed will come in and bail you out. But if you lend to Africa, you won't get bailed out, you'll get penalized, and you'll have to take a haircut. And that sends a tremendously dangerous message, I think, for a continent which I think the African Development Bank is saying needs $100 billion. There's $100 billion a year of unmet financing needs. So I feel like trying to bail in the private sector, I totally understand you want to get the Chinese banks on board because effectively they're an arm of the Chinese state. I can buy into that argument that they could accept a moratorium. And it wouldn't be that costly for them. Their interest rates were pretty low anyway. But I think from now on, people should be looking to the future. And the future is that there's going to be more capital thrown at Africa, I think, in the next 10 years than has ever come the way of this continent. I've got 2 slides I'm going to try and show to you, if I can. And the first one is just a slide I've been using a long time now, since actually the global financial crisis 10 years ago. And the red line is what German bunds have been doing, yields on the right-hand side for the last, since the global financial crisis, tracked against Japan, the blue line, on the left-hand scale. And you'll all see that I'm cheating horribly on the scales. This is a chart crime, and I apologize for it, but they are different yields, it's true. But the trend line has been extremely similar between Germany and Japan. Germany is Japan with a 15, 20-year lag. And the US Treasury line, which is the green, just above it, has been coming down and held down by those low borrowing costs in Germany and Japan. And I think what this is telling us is, because this chart for Japan starts in 1990, it tells us what's coming in the US and Germany. And I think we're not going to see US Treasury yields above 2% in the next decade. In fact, I guess that they end closer to zero. And the consequence of that will be that emerging market borrowing costs are going to drop. So if we go back just 20 years, emerging market borrowing costs were about 12% in dollars. That was the normal yield. So if your debt was 40% of GDP and you're paying 12% on it, your interest cost is 5% of GDP on the right-hand side there. Now, by 2010, yields were down to 6%. Emerging market debt could double to 80%, but the interest cost didn't rise. Today, yields are 4%. And again, the debt could go up another 40% of GDP. But in the next 10 years, I think we could see the biggest increase in debt yet to 180% of GDP, falling yields, and the interest burden still doesn't go up. So the point that I'm coming to is that people are going to be desperate for yield. Those US pensioners sitting there in California, putting their money into CalPERS and saying, please find me yield. And CalPERS are saying, well, here's 0.5% in US 10-year, or you can lend to Nigeria at 4%. And they really need the money, because this is the decade when most of Africa has got the adult literacy level you need to industrialize. For the first time in the last 10 years, most of the continent has it, but they haven't got the electricity. You put together the electricity and the adult literacy, and you've got the two preconditions for an economy to start giving the growth of 5 to 10% a year, which every African economy will do. It's just a matter of, do we have to wait 10 years or have it now? And I think a lot of countries should be considering borrowing at cheaper and cheaper rates to try and kickstart that infrastructure build in the next 5 years so that you can start delivering that high growth. I think it's well within the realms of where we're at. And given the $1 trillion of unmet infrastructure needs in the next 10 years, the DSSI is a really helpful, 11 billion, I think, for this year, but someone can correct me. But it's not the biggest story here.
All right, Charles. So I think as you were speaking, I could just imagine that at least two groups of people were getting more and more anxious with every passing statement. You know, sort of the one group of people were the people who are beginning to worry about, like, you know, this is going to create serious debt sustainability problems. You know, half the countries, and half the low-income countries, the IMF thinks, are already at risk of high risk of debt unsustainability. And then there's another group of people who are essentially saying that, you know, this money has always been there. And you know, we've kind of had this conversation for 10 years now about how private money is going to come in and finance development. And yet here we are today. And the reason it's not happening is because there are lots of impediments between the money on the one side and the lack of electricity on the other. And connecting the two is really been the Achilles heel of making that basic equation work, which you so eloquently laid out, and which will become even more compelling in the future because yields are going to be so much lower, you know, as you're saying. And I wanted, if I may, to bring Chieta into this for a moment first, and then come to Tidjane, if I may. And Chieta, you know, you're looking at risks. So you listen to Charles with his kind of like, you know, there are billions and trillions that are sort of just going to be flowing, and it's essentially a yield-based, you know, there's the need and the potential on the one side, there's no returns on the other, there's all this money looking for yield. It's got to go there. And so now you're looking at these economies. How realistic is this? What are the impediments and what are the risks that as an investor people are looking at and that should be concerned about? And what can African countries, what can Ken and his colleagues do to make this a reality? Because we'd all like to see it happen.
Hi, once again, thank you for the opportunity to express some views based on the question that you've just asked. I want to have a quick sort of practical discussion about essentially what's at stake for the region. Obviously on the investor side, they also don't want to pour money down a sieve. So the crux of my argument is that it's really down to reform momentum. So essentially debt suspension could be a significant positive for Africa, but without concomitant reform efforts, it's mainly a short-term remedy. And it's important to look at why debt loads run over in the first place, what debt is being used for, and how it can be used better in the future. And further to this, it's unclear if the savings from initiatives such as the DSSI can significantly trickle down to the populations that need them the most. It's hard to see how these savings can be audited and what the impact of resource misallocation and corruption risks can be. So the COVID-19 pandemic and the resulting global recession will have long-term ramifications for growth in Sub-Saharan Africa. We will see lower for longer growth if you compare with the previous decade. There are implications for political risk as well as government policy. So looking ahead, countries in the region really need to fast track the implementation of pro-business reforms and seek to roll back, or rather reassess the role of the state in infrastructure development, especially when you look at infrastructure capacity building. I believe that countries that are implementing much needed reforms will also benefit from future inflows of capital, very much in line with what Charles has expressed. But to start, while DSSI can help to create fiscal space for countries to address the challenges related to the pandemic, the effects of these initiatives are limited for several reasons, some of which have been explored, which is firstly that debt repayments are still due to other private bondholders and creditors. Secondly, the application of arbitrary income thresholds has excluded other African countries that are in need. And the initiatives are currently only open or applicable rather for a short time frame, which begs the question, what happens after 2020? What happens after 2021? And to kind of tackle these questions, we have to unpack what was happening before COVID-19 and the role that global partners and investors can play in supporting the post-COVID recovery and the next normal. So the reality is that many economies in Africa were saddled with rising fiscal deficits, high debt burdens, even before the pandemic struck. And this is against the backdrop of sliding economic growth, structural risk factors related to low trade diversification, and of course, widening inequality. And further to this, some sub-Saharan African states, as you rightly stated, that are eligible for DSSI haven't applied because of these concerns about creditworthiness and investor sentiment further down the line. And of course, a more specific and complex reservation has been the concern that some non-eligible debt contracts contain cross-default clauses that could be triggered by the DSSI participation. So from the private investor side, for this specific initiative, it's hard to see how they can engage. Private creditors and investors face various regulatory and commercial pressures that limit the degree to which they can participate in debt suspension now, especially on such short notice. And the private sector creditors have a responsibility to their stakeholders too. You're looking at entities such as pension funds, etc. But there are practical ways to incentivize private sector participation. And really, this comes down to boosting the availability of bankable projects. So, it's kind of important to highlight that this is not the first crisis, and it's not going to be the last. Debt suspension, cancellation have been tried before, and as seen in the past, debt suspension without reform commitments risks sort of papering over the intrinsic need to boost internal capacity and resilience. So in fact, sort of DSSI flow relief and new IMF loans by design are not adequately geared to address the sort of medium-term risks to debt sustainability. And right now, a lot of African countries are sort of bogged down by the impact of unsustainable subsidies, large public sector wage bills, and the sort of recent push to invest in large-scale infrastructure that has low and inconsistent payback potential. And these have kind of been key contributors to rising government debt to GDP over the past decade. Meanwhile, on the ground, income levels have hardly risen, and the state has very limited capacity to actually support vulnerable population groups in Sub-Saharan Africa. And this is particularly stark when you compare with the responses that we're seeing in other emerging markets such as Latin America. So just what I'd like to highlight is that COVID-19 is an accelerant and a microscope where poor governance and corruption risks run high. Debt relief alone does not translate to impactful spending on social welfare or economic development. So it means now more than ever, it's important that supportive policies are guided by long-term considerations and not just sort of short-term quick fixes.
Thank you very much, Yud. So, Tidjane, might I turn to you now? I was going to say you've seen it from all sides, and you have a great sense of the constraints on both sides. And I think in a way, what Charles and Yud have just highlighted is that the potential is great, but we know that the reforms are not easy to do, and in the past there have been difficult. People have started with good intentions, but it's hard to follow through. From where you sit now, and among other things, you have this role also as being an envoy for the AU right now on looking at the financing. What's your advice now to both sides? What do you think is the most constructive way forward, given where we are and given the constraints on all sides?
Okay, well, Masoud, I was going to start by thanking you for this opportunity and for inviting me, but after I heard your questions, I'm not sure I should. So anyway, these are not easy questions to answer without being flippant about it. I'd like to say hello to Ken, who's doing a great job leading the African ministers, and salute Charles and Chidza, who came before me. If I try to put together what I think, I think a lot is consistent with what I heard. I hope everybody can hear me, because I'm seeing that my connection is unstable, so I cannot see you, but I hope you can hear me. I'll take one big point from Charles, which is the need for additional resources. I completely agree with that. I think whichever way you look at this problem, you just can't fix it if there is not a significant influx of new resources. And I was like him at the beginning. I got engaged in all this because I thought this was a unique opportunity to get that outcome. And it hasn't happened. It hasn't happened because the lesson everybody learned from 2008 to 2009, and at that time I was CFO of a financial company, is just that if this comes again, you need to pull out a huge gun and just shoot it down. And that's what the Western economies have done. I think there's a unanimity on the fact that it's not even a Greenspan put. I mean, nothing can go wrong right now in the economy, because so much money is being just pumped out in the economy. But the Western economies are bulletproof. I mean, my son, who happens to be American, just told me he got $1,200 and a letter from Donald Trump. I mean, it's really, they're just helicopter money, just distributing money. So that's propping up the economy, the markets, there are elections coming. But if you go back to Africa in that context, there's just not a focus on us. I mean, we're really struggling to get share of mind, really struggling. I mean, every conversation I have my former peers, other CEOs, etc. Maybe it's rude to say, but the level of attention is very low on Africa right now. And we know that the shock has been very significant to a number of African countries. How do we get out of that? I think a lot has been said by Ken, by Shida. It's really it boils down to trust in the end. And trust is fickle, as we know. Very hard to gain, very easy to lose. It's completely asymmetric. I think it's important that, yes, nobody's going to invest. Put my private sector hat here. Nobody's going to invest in a country if you don't have trust in the government. It's a necessary but not sufficient condition. Often people think it's not sufficient, but it is necessary. If you really think that if you have a problem and you go to the legal system, you're not going to get anywhere. Yeah. As Charles said, you just buy Google. There's a big risk-return trade-off here, but it's just not in favor of Africa. So having everything that's trust-inducing, trust-enhancing is very important. Among that, there is consistency. When I was in government, I always argued, I'm not necessarily a conservative, but I always said that there was a high opportunity cost to changing anything. Okay? One reason I like the US system is that the checks and balances, it's the system where the politicians have the least power. And that's why it's doing better than all the others. It's a very smartly organized paralysis by the founding fathers. And if you take France, in 81, there were massive nationalizations, 86 massive privatizations, 88 renationalizations, 93 reprivatizations, 97 renationalizations, and this is a developed country. Okay, when you are a private, you ask me to put on my private hat here, you have a choice. The thing the countries need to understand, you have a choice. You don't have to invest in Africa. So when you see that type of pattern, you just stay away. And this is why so many strategies that were predicated on massive flows of private investment were confusing the effect and the cause. The private sector flows are a reward, not a condition. They reward good management, sound governance, and people who think that the answer is the private sector flows, they're inverting the cause and the consequence. So it's hard to reform when you don't have a lot of money, but there's no other path. All the other paths are worse, and you're going to end up worse off. It also makes it easier to then pitch for increased resources, for because I think Fidza mentioned that if the money going in, and I said this during COVID, Vera is my witness, that really this was a very high risk period for Africa, because if we misused those resources, the cost would be very high for us. And I'm not even getting into whether DSSI is working or not, but any gesture made by the international community is long-term potentially toxic if we misuse it, or if we don't put the resources to good use. So there is no easy path. I mean, there will not be a shortcut to being an economy that's attractive to private sector capital. Just to throw in a few things, I really think that a thriving domestic private sector is the number two. If step one is a good government, the second thing I look at is, are there local companies that do well? You know, it's almost like if you're in a science fiction movie, before you take off your cask, your helmet, you're going to look if people can breathe the atmosphere. Right? If the atmosphere is toxic for the locals, you're not going to go there. So you want to see that there are native local businesses that can actually operate. Because you think if the environment is toxic, I'm coming from abroad, there's no way I'm going to do better than these people. And if I can't make it, what would make me believe that I can make it? So really, sorry, I'm repeating things that everybody knows, but making sure that really there is a, not just thinking about the foreign investors. I often say the best way to attract them is to have thriving domestic companies, because that's what they look at. And a lot of governments, instead of looking after their constituency, they spend a lot of effort and time trying to attract people who will not come because they don't see. Yeah, they'll be polite, they'll give a meeting, but you know, you're not going to see the money come if you don't have domestic.
Or who are only coming because you're offering them some sweetheart deal.
Yeah, offering them tax. I mean, yeah, exactly.
Add
Free
any
money.
value to the economy because you just
exactly free money.
You paid a price to have them there rather
exactly free money. But I am very positive. I don't want to talk forever, but I'm very positive because a bit like Charles, I believe that demography is a huge factor. I think that the demography is driving the yield curves. And as he said, I've said exactly the same thing, but Germany is just Japan kind of 20 to 30 years earlier. And you see that going on. I mean, Indonesia has 28 average age. Europe is like 44. The US is in between, 36, 37, going towards the 40s. So yes, the potential of growth is in Africa. Yes, the demography is very positive for us. But that's provided we can create an environment that's conducive to growth, so that the demography is a plus and not just a kind of time bomb, as we also see in a number of countries. So I don't think I can come up with a single factor that is not known or that has not been mentioned. I mean, we message that there is no shortcut. We can't, how can I say this, avoid certain painful adjustments of discipline, of fiscal discipline, of, being selective. A lot of people talk about bankable project. I remember in 2011, I chaired a high-level panel for a G20 on infrastructure, and we were saying, we were saying the same things. Bankable projects, have a pipeline of bankable projects, produce good returns. But I think this kind of language of moderation is also very important because lenders want to see that borrowers are realistic. And sobriety often is a very important component to credibility. And let's not promise, say in English, in French we say promise the moon, but let's not over-promise and under-deliver. Let's under-promise and over-deliver. And if we do that consistently, really the rewards come. You're going to trade at a premium, people like you, people come back. But, and my final thought will be just, I've rarely been in discussions on, how can I say, investment in Asia. I've been in panels on investment in China. I've been in panels on investment in the Asian. I've been in panels on investment in India. I'm of two minds about this. I'm a proud African. So I like Africa to be discussed as a whole. But I also think that sometimes maybe we need to segment that conversation more because really it's very unlikely that the answers are going to be, the right answer is going to be the same for everybody. I mean, several people mentioned that different countries are in different places. Some are in trouble because they were already in trouble before COVID. So COVID has just exposed them, and those deserve a certain type of solutions. Others were doing okay and are really COVID victims. And for me, that's like the most deserving group because really this is an exogenous shock and we need to really help them manage through that. And there shouldn't be a sanction or moral hazard or what Ken was saying, it shouldn't be punished because there's some coronavirus that appeared in China. That just doesn't make any sense. Right? And then you have a small number of countries who can probably make it anyway. And we need them. We need to make sure we look after them because they will contribute to enhance the credibility of Africa if they can go through this without debt relief, debt rescheduling, or anything like that. So I'll stop here. Just a bunch of thoughts, nothing revolutionary, but I would advocate discipline, sobriety, consistency.
Thank you for saying that. I like the way also, Shedza, you said that, I mean, a lot of people say COVID is an accelerant, but I think you said it's an accelerant on a microscope. And I think the addition of the microscope part is quite important. And Ken, and I would turn to Ken in a minute, but But Tijana, what you just said in a minute ago was very relevant, because what you're saying is that I think we still are talking about financing for Africa, when actually it's going to be financing for different countries that are progressing and dealing with their issues at a different pace. And maybe that's the sort of next bit of the conversation that one needs to start thinking through, is how can we support those different categories of countries, particularly the ones where the microscope shows that underlying they were trying to do the right things, but they've just been hit by an exogenous shock. And in a way, and this is a point that Philippe Leroux made when he was having a conversation with us, is that if you lose the social capital of functioning SMEs because you have 18 months of an economic slowdown that means they don't survive coming out, it's not so easy to recreate an SME sector having lost them. So, there are functioning things that need to be protected as much as anything else to ensure that the recovery happens. Vera, is this a good moment to sort of come back to you a little bit? You've heard all the different perspectives, and I want to square this conversation, which is very much about, it's essentially the conversation we would have had before COVID. If you think about it, that there is a lot of potential for private financing for Africa. There's clearly a need for that financing, but the path to it requires a set of disciplined reforms and consistency over time in predictability, because nothing is worse than uncertainty for a lot of, if they don't have confidence and trust in your policy framework, the best laid policy framework will only struggle to get an outcome. And now there is a sort of separate conversation that is going on saying this is the sort of once in a century pandemic, and that everybody's been hit, and we need to essentially provide money without conditions. That's what we're doing. The helicopter, the $1,200 that your son got, Tijan, in the US, didn't come with any conditions. So the point is, people are saying we need some version of that right now all over the world, particularly in Africa. And this is not the moment for the international institutions to be talking about reform. So how do we square those two conversations and try to put them side by side?
No, thank you. Thank you very much. I think this has been extremely useful. How do you square the two conversations? It's a little bit of what Charles said and a little bit of what Tijan said, all served on the plate of what Chidza said. We can't start doing reforms today, that's clear. I think that when you have to choose between lives and saving your economy, it's very difficult to then, if you're South African Airlines, do you then fire half of your staff in a difficult global pandemic, the largest recession in Africa has seen in 25 years? Probably a difficult decision to take, which is why I think that I join my voice with Kristalina's when she says the countries that got into this crisis doing well before the crisis are probably those that are going to continue to do better because they had already started, they had already put their heart in the good fundamentals category. And so, and I think that's what's important in this conversation, that we distinguish the good fundamentals category from the not so good fundamentals category. There is a tendency when we talk about the continent to say, oh my God, debt distress across the world. But that's not the case. Maybe we have 16% of the countries that are or were already in debt distress before the crisis, maybe another 20 that we're heading towards that direction. But a lot of the others that were had good macro fundamentals, and those are the ones that tend to get forgotten in this conversation about bad fundamentals. So you have sort of a 16% of the bucket clouding the rest. Now, for the rest that had good macroeconomic fundamentals, I think the difficulty, and that's where I think, Charles, your point is very pertinent, they need liquidity now to continue on the path of reform. Because the easiest thing to do when you're in trouble is to roll back reform. And so if we don't give them the liquidity that is needed, they will roll back the reforms. And then, of course, we will end up with not 16% in debt distress, but 30% or 40%. But that's because we've steered them in that direction. The $13 trillion that was put into the economies of the G20 was not because they were on good economic reform paths. It was just to make sure that at the very least, they don't roll back. That at the very least, they stay where they were before the crisis happened. And I think that is the importance of making sure that there is some liquidity that is being put into the system today. And then we can look at how we go forward. But again, the policy environment determines who will come in to invest. And this will always be the truth. You cannot have, yes, you know, we talk about Nigeria, we talk about Ethiopia as large economies. And so there is a sort of natural attraction because people want to go where there's scale. But even then, you know, there is scale up to a point when the scale, you know, begins to compete with, you know, policy uncertainty, with macroeconomic distress, people will not go. And we see that in South Africa today, we see that in Nigeria today, two of the largest economies on the continent whose growth is less than 1%. However, in places where you have better policy certainty, we have Ghana, we have Kenya, we have Cote d'Ivoire, they're growing at 7%, investors are coming. But an important point I think that Tijan made is this local private sector. On the continent, we have almost sort of taken it as a pride to favor attracting foreign capital and not done as much in attracting domestic capital. But domestic capital is the one that stays with you even in terms of hardship. So today, when everybody is running off and going to buy the Google stocks, the local capital has nowhere to go. They have to stay and they have to continue with us. And essentially, I think part of the build back and part of how we redefine our economies is really to begin to favor this domestic capital. Plus, they are also the ones who tell you when policy is going wrong faster because they're hurting the best. And they are the ones who build a better supply chain to the SMEs. The SMEs across the world, not just in Africa, are the ones really that are the drivers of our economies. They're the ones that create jobs. But essentially, they are servicing a few big, you know, industrialists. But we need those SMEs to continue to function. It's easier if you're in Cote d'Ivoire to do local content with the local suppliers, if you know them, if you trust them, and if you understand them better. And I think this sort of SME, small scale private sector side becomes quite important. And there I want to, and I stop, and I want to come back to Charles maybe a little bit, is the link between, you know, the capital markets. Africa hasn't built secondary capital markets where, you know, the SMEs and our small and medium enterprises can actually access market capital. And so we still, you know, today, and Tijan was talking about his son getting a check, the SMEs in the United States are getting checks. The SMEs in Africa are mostly in the informal sector. So they're not getting any checks either. So nobody is standing them up. So we're left with two choices on the continent. We need to stand up the government, we need to give them more resources, and we need to find the big companies and continue to give them more resources because it's raining again, because that is the only way that we can do it. But I think that these are the tensions that we have is policy certainty, better investment environment is always going to be a winner. I don't think crisis, no crisis. And even in terms of crisis, I mean, we're seeing Argentina taking some difficult reforms, right? They have no choice. People will say that the IMF has forced them to do that. But Egypt did difficult reforms, even when they may have decided not to. So we have examples of countries that have, and Egypt is now going back to the market. They will still argue at higher rates, but at least the market is willing to entertain Egypt because it has good macro fundamentals at the beginning of the crisis. So I think the macro fundamentals, good policy environment will always be a winner, crisis or no crisis. During a crisis, maybe we can make some exceptions, but I think we must come back to that very quickly.
Thank you. I think the point that you just made is a very, very important one, which is that linking those two conversations, that while good fundamentals are going to be key to getting support from markets in any environment, if you withdraw liquidity in the middle of a crisis, or if you don't have enough liquidity in the middle of a crisis to keep things going, whether it's individuals, families, or firms, it makes it much harder to come out at the other end and pursue the path of reforms you were on. It also, in a way, makes it much harder during that period not to backslide. And I want to come back now to Ken, if I may. You know, Ken, you've sort of listened to these different panelists talk about, and the conversation has really sort of highlighted to me what is kind of the potential. You know, people are saying, look, there is a huge potential out there. The objective forces of demography, yield differentials are going to be a big force for putting money into economies that can yield more, into projects that are bankable. And so the real issue is, how do we create the conditions and that reduce the risks for people so that the risk return profile improves in investing in those markets. And one of the roles of official institutions has been to actually help countries with those reform agendas. And there's a question now about how much of their focus should be on kind of reinforcing the reform agenda, as opposed to, or in conjunction with, what Vera was just saying, which is the need to provide liquidity near term, quickly, and in adequate amounts to actually help people just come through this wave of a crisis that we're going through. I get a little bit your take on these comments that have been made.
Masood, thank you very much. No, very interesting discussions. And, you know, the whole issue of even the definition of Africa's risk and, you know, the way in which it is defined. I mean, you look at Argentina, goes through its crises, and then it comes back and is able to borrow at the same rate that I am borrowing at. And I've not defaulted in eons, nor do I look like I'm going to default. So I think that there needs to be some acknowledgement of this unconscious bias in which we build up truths from it. And maybe we can say, well, what will Trump say? It is what it is. And so, you know, find a way around it. But it's just so fundamentally wrong, this whole financial architecture that we are all accepting as the base from which we move. You know, the Canadian finance minister was saying, well, we designed it in 1944, why don't we redesign it? You know, and that changes. I mean, to think that if I were to be able to construct a wraparound of Africa's debt, then I can be coming to the market at 2% or something, which means therefore that this $44 billion of debt servicing that I do each year could be as low as 10 or 12%, leaving, you know, 30 billion back on the continent. So I think that the need to confront that, you know, has to be done. And then all of these other things that we are talking, sure, but it just seems to be so expensive to do the things that others would normally do. And I don't know how long we are going to sustain that if we continue with this paradigm of power and resource as a foundation of infrastructure in which we are working with. It is true, I look at Ghana, and one of the very first meetings with the president when COVID was upon us was the Ministry of Health thinking, you know, why don't we find some $2-3 million to tackle this problem, and then we'll go, you know, a spirited discussion with the president and chief of staff. And, you know, he was about to close the meeting, and the president said, Minister of Finance, go look for $100 million because this is bigger than you all think. And now I'm looking at this man and saying, Mr. President, $100 million, okay. But it is that type of audacity, you know, which then you can say 6-7 months later, the president's vision has come to roost. Ghana seems to have done something impossible, incredible, which a lot of African countries could have done. And so in the same vein is which I guess Vera is then saying, where is that capital to be able to inject, just as was done during the financial crisis, just as is being done today, so that we can then begin to look at these variables we look at to give ourselves this money. So yes, I mean, discipline for ourselves, the sobriety, as Tijan would say, and then getting us to speak at a table. You know, that the issue of the private sector going to be completely disillusioned if a certain structure is put in place, if there is no coordinated and synchronized effort, sure, it will look like Africa is, you know, Africa. But honestly, if you look at what could potentially happen next year going forward, you know, the solution, the finding a solution of restructuring debt, of you know, the sort of bankruptcy laws that you even have in the States, does not lead to people not investing anymore, if it leads to the type of resolution that we are looking for. And whether we are going to really sit down and look at that, I think we'll keep, you know, chasing our tail and wondering, you know, what is this spiritual stupor that is not allowing us to put the variables down and say, to make sure that this market continues, we all need to make certain adjustments to go forward. But that's going to require some real statesmanship and leadership, which we in our little silos and expertise and corners, you know, are not ready to perceive. You know, the logic of today sounds so sensible, but I think we are going on a very unwise path.
Yeah, I think the point you made really so many important points there, but two that I want to pick up on. You know, one, this argument of sort of what you pay to borrow, and one of the viewers sent a question essentially saying, look, you know, the revised outlook for Ghana shows debt service and public service salaries totaling 122% of projected revenue. And that, of course, you know, is very high, right? By any calculation, there's a problem there. But some of it is driven by the denominator, the revenues falling because of COVID. And some of it is a function of the rate at which you have to borrow. Even when, as Charles was saying, you know, risk-free rates for treasury bills or in other countries, rich countries, are close to zero. So do you think that this raises a question, which is whether one of the contributions the international financial institutions should be making more a priority is to find ways in which they can help bring the rates down? And there are many ideas. Vera, you know, you have had this idea for a while about having some kind of refinancing facility. There's a notion of whether there can be more of a use of sovereign guarantees or other ways in which you can bring down the cost of capital for emerging markets. Is that a productive route? And I think that would be one area that be good to get your comments on. And the other issue you said is that sometime next year, some subset of countries, some in Africa, some elsewhere, but quite a few in Africa, and I don't know what the number is going to be, but it'll be double digits, will need some kind of debt restructuring and write down beyond just pushing the can down the road by a few months or by a year, and because the real problem is the stock of debt. David Malpass has come out in a couple of public interviews and said that they will need to be that. That, of course, gets a lot of private sector people very anxious because they think they will have to be part of that. It's very hard to imagine that they won't be. But do you think what's the best way to tackle that? Is it to try and put boundaries around it soon, or be clear about what needs to be done, or is it a question of, as we are now doing, sort of sort of saying it might be needed, but I don't really see yet any clear framework for addressing it. So any final thoughts on those issues from all of you would be great before we wrap up. So Ken, I'll come back to you first, John, because you raised both these points.
No. Masood, why don't I go later? Huh?
Okay, I'll come back to you later on that. Sure.
Yeah,
let me come back to you. Let me go to Tijan then on these 2 points, but both in terms of helping to reduce the cost of borrowing and how best to tackle this impending issue of debt restructuring write-offs.
Yeah, it's thank you, Masood. It's a lot of very, very good comments. It's a bit of a difficult one because I'm for my sins a great believer in markets efficiency, and again, most of the time the pricing is okay. The issue is really pricing under times of stress. I think that's where Africa stands out. Because it is true. I mean, we saw it again in 2009 or in various crises, or Brexit in 2011, the euro. When the liquidity dries up, you can have completely aberrant pricing, and particularly on small volumes, which is what we see in Africa. Generally, the pool itself is small. The volume traded daily is very small. So even in good times, there's not a lot of liquidity. In bad times, the liquidity disappears. So then, to draw any conclusion from that is probably wrong. And I think that's where we come to Vera and all the ideas that she has been eloquently promoting around finding instruments to intervene at those moments. And all the developed country central banks do it. They all do it customarily. I mean, I've been on calls with Paul Tucker in 2008-09 on various segments of the gilt market, and we managed it. I mean, it's normal. So I think it's one case where we are trying to people are trying to treat Africa as an exception, where when all that's being asked is actually a kind of normal treatment of Africa. Those interventions at times of stress are customary in any organized capital markets. And I actually think that the lack of it is an impediment to the development of organized capital markets. So my argument, Vera's argument, is to say, well, we need a repo market. We need all those facilities because it's also going to discourage. I'm sorry, in November 2008, the London Stock Exchange stopped short selling, okay, because it had become such a one-way bet, and people were making so much money, and it was creating systemic risk. And in spite of all the theory about value of prices as market signals, it was just suspended from one day to another, and all the hedge funds started crying. So in those situations, if you're the public authority, regulator, and you don't intervene, actually often what you're creating is just windfall profits and one-way bets for pointless speculation. So I would say there is a very strong case for those ideas to be implemented. To be honest, we have not made much progress. I mean, I look at Vera here. I don't know if there is any update, but it's we've made all these points, and we have not been very successful so far. But I think we need to continue pushing because it's a source of unnecessary vulnerability. There are enough vulnerabilities in the African economies. We don't need kind of avoidable crises, and those spikes in prices are completely avoidable.
It's quite interesting and ironic how a call for a level playing field is often criticized as a claim for special treatment. And in fact, as you say, what you're asking for is what that proposal is one way of dealing with the issue that is not a new problem. It's a problem that other countries have experienced, have found ways of dealing with, and that set of mechanisms and instruments is not available to many African economies. And that's the problem that you're trying to address. It's not some special, unique problem that you're trying to find a unique solution to. So I think I take that point very much. Shiza, any final thoughts?
Hello, can you hear me?
Yes.
Excellent. Yes, just sort of adding to the points that have already been made, I think the emphasis going forward should be on bankable projects, and it should be on mobilizing both foreign and local capital. Because in essence, as was expressed before, investors want yield, but they need to be able to access these opportunities. They need to be able to calculate risk. I wouldn't put it to an necessarily unconscious bias that drives sort of high yields or high risk premia in Africa. It's that there's a tinderbox of FUSC risks where it's difficult for markets to actually price these. So creating more transparent regulatory environments will work out positively in the medium to long term. So Africa actually just needs to embark on an aggressive credibility building exercise, which we actually have started to see take shape in some of the regional bright spots when you consider reforms in East Africa, and was mentioned in countries such as Egypt and Angola. We're actually starting to see green shoots of reforms. African countries, African governments have agencies. You know, the government also has a very big role to play in liberalizing investment environments, especially, as I mentioned before, in the infrastructure space. But just to sort of add on and kind of bring it back to, I suppose, a grassroots level, if we're talking about SMEs, we're talking about local capital, we need to look at how we're pricing risks across markets, especially with the coming into effect of the Africa Continental Free Trade Agreement, how to mobilize and SMEs and sort of strengthen industrial linkages, cross-border linkages, sort of leveraging the Africa Continental Free Trade Agreement, which is a big positive. I think on the aspect of things like transaction costs, if you look at remittances, I think these are real pain points for SMEs as well as, you know, ordinary people on the ground. Transaction costs when it comes to, and risks, I suppose, when it comes to remittances, mobile money, and even trade finance. These are things that we as Africans can lower here on the ground. So, you know, just kind of creating platforms that allow for interoperability, that allow for greater cross-border cohesion are or could be helpful. In fact, Africans pay some of the highest transaction costs when you look at remittances, double-digit, you know, sort of costs in terms of percentage of the money that they're actually sending. And this actually erodes the impact of diaspora aid, because remittances actually make up a large section of you know, sort of foreign currency receipts throughout Sub-Saharan Africa. So how are we pooling these remittances as well? And how can we mobilize these to kind of get economies back into gear on the ground? And look, I think it's time to focus on building resilience. And just to kind of head back to the United Nations Sustainable Development Goals, these were crafted with the central principle of leaving no one behind. But the reality is that Africa has been left behind. So it is a catch-up exercise. I think we have to come to terms with the reality of that. There was a health and a debt crisis preceding the pandemic. If you look at WHO data, you know, healthcare spending per capita was already a 10th of global averages when you compare with Sub-Saharan Africa. And there are also practical aspects like building capacity in terms of water infrastructure, in terms of energy infrastructure, to help strengthen, I suppose, the competitiveness of African operating environments, and for governments to allow cost-reflective tariffs, you know, to be present in markets across the region. So again, businesses and investors can price risks adequately. And one final point is that Africa desperately needs to tackle the identity crisis. Again, legal identity for all and birth registrations by 2030 is a fundamental target of the SDGs, yet there are 500 million people in SSA who can't officially prove their identity. And without proof of identity, these millions are missing out on basic legal, social, and economic rights and opportunities. And there are gender dimensions to this too, with future implications for social stability, labor market risks, and regional security. But we've seen limited progress in this regard, and it kind of begs the question for this pandemic, and I suppose for other crises to follow, this is not the last, how do we adequately conduct relief efforts, let alone proper contact tracing without IDs?
Exactly.
So
I think the ID
development partners can assist in that respect.
Right. All right, we're running a little bit over time now, so I just want to quickly ask Charles for any final thoughts, then come back to Ken. Charles.
From my perspective, you wanted a short-term, easy win to get borrowing costs down, and doing an IMF deal, a proper 2 to 3 year IMF deal, as Egypt had done back in 2016-17, is the easiest way to do it. Ideally, when the IMF isn't suggesting anything at all, they're just doing exactly what the Egyptians have already decided to do. But if Nigeria did a deal, if South Africa did a proper deal, not just condition-free financing, borrowing costs should be lower. But the only other point I wanted to bring in was that to come to Tijan's point, which I thought was obviously excellent, about the fact that Africa is so varied. Perhaps one of the biggest and most important differences is high fertility countries versus low fertility countries. Low fertility countries have huge domestic savings, very low interest rates, whether they're China, Vietnam, Mauritius, or Morocco. Morocco can borrow 2% in 10 years, local currency or foreign currency. Why? Because they've got a low fertility rate. There's a whole chunk of Africa which is going to come through in the next 10 years and become low fertility countries. Egypt, Ethiopia, Kenya, Ghana. And when they do, their domestic borrowing costs are going to come down dramatically. But that's not for 10 years. So there's this little window, well, say little because I'm getting old now, it doesn't feel that long, 10 years, 10-year window where you can actually borrow externally to fill the gap when domestic savings are not high enough yet, so interest rates are very high domestically. And I just think it's well worth countries not jeopardizing that, because we still remember Kenya didn't join up the HIPC deal. And people who are as geeky as me know that Finland never defaulted on its war debt, World War I debt during the Great Depression. It was the only country to not do so. That helps. In the long run, it helps. So I think countries should be very wary of jeopardizing the financing that's available in the next 10 years.
Thank you, Charles. We could have a separate conversation on what the counterfactual would have been for countries that did join up for the HIPC deal if they hadn't, but that's a different and separate panel. So let me come to Ken for any final thoughts, and then Vera for any closing comments.
Thank you so much. I mean, I think it's this has been very good. You know, I think you know, we should understand that fundamentally, unless there's a tectonic change in the global financial architecture, we'll be talking about these same variables. I mean, explain to me why a simple remittance from England to Africa should cost more than from, you know, what is that? Or is it what, a computer? So until we begin to really acknowledge this unconscious and systemic bias in the system, yeah, that's a lot of money. And then I'm borrowing from ECA, and I have to pay insurance of 6% upfront. And, you know, so it just continues to add up. And then you talk about illicit financial flows. 55% of that is commercial transactions by the OECD, you know, countries or companies. So that really has to be interrogated, because it redefines our risk. I mean, there's nothing that is happening in Africa that has not happened in any part of the world before, but we continue on this. I think, Charles, the issue of getting some easy wins really is at the heart of the SDRs. Nobody can philosophically tell you why we can't bring the unused SDRs so that we can cure this problem of a stimulus for Africa. But there's a fight in the US, there's a fight in China, and so therefore we are caught in this, whilst we could slice through this quite quickly. So the excuses of Africa's credibility and a liberalized market and all of that, I don't know which markets are even more difficult than the Middle Eastern markets. But we find a way to work there because, you know, certain things are done. But, you know, I'm really hopeful that really if we ourselves as a continent, and really what also triggered me, for me, was the 100% unanimous vote for the president of the Africa Development Bank, where suddenly the non-regionals and regionals seem to have determined that coming together to push things ahead will be much better for the continent. So as I was telling the president, the issue of digitalization for Africa is just key. It opens us our ability to dispense, you know, our welfare programs more effectively. It's a way in which everybody can pay a bit of the taxes, and more importantly, it's also a way in which we can cut out these illicit flows because there'll be a lot more transparency in how we lose revenue. I think we really need to continue with this fight, and there has to be a certain language which tells the private sector creditors that it is in their own interest to avoid almost an imminent default coming next year. And Masood, I mean, if you examine the returns of some 43 trillion odd of assets under management, negative returns, barely treasury bill returns, and barely above zero returns. What is that compared to rewriting the rules such that that type of money can be used for an infrastructure build-up of the continent, which then opens up this continent for mutual global prosperity? So where do we get those statesmen and minds that can convince their various capitals that, you know what, this is actually better for you and it's not a favor to Africa? So that we shall continue to persevere. Thank you.
Thank you very much, Ken. I think really what you're saying is that this is a moment for us to look at some of the basic design of the rules and the frameworks that force us into suboptimal outcomes. I mean, we've been having a conversation about the high cost of remittance transfers for a decade. And I can find you reports that are 10 years old that have started chronicling how expensive it is and how important it is to try and save that. And here we are 10 years later, and I don't really see a big drop in the cost of remittances to most African countries. There are some areas where there have been improvements, but many others there haven't. So you can identify half a dozen problems like this. And that becomes really a question of saying, why does the system that we've created not allow us to make progress? So Vera, this is your closing comment. Why does the system not allow us to make progress? And how can we? Any final thoughts before we close?
That's a tough one. I think, first of all, we must acknowledge that African countries have shown an amazing amount of resilience, because my sense is that in March, you know, the headlines were all about Africa about to collapse, and we would go begging, we would go rushing. And I must commend the Kens of the world, you know, and, you know, the good thing about, you know, the Kens of the world is they always have this very quiet face. So you don't know the stresses of calling him and him saying, I just came back from budget, I've redone the budget, I've done this. But we must say that, you know, most of these economies have been resilient, you know, and we keep praying every evening that they continue to be resilient, that our numbers on COVID do not go up as fast, and that, you know, we can reopen our economies and start building back again. But I think there almost is sometimes a self-fulfilling prophecies. You know, we've said they're going to collapse, so we're going to make sure we don't support them until they collapse, and then we'll support them, because then we would have confirmed our priors that they were going to collapse. It's almost a little bit of that. Sometimes you think about it in the system. But I also think that there was maybe an expectation that, you know, the COVID, the health part of the pandemic was going to hit Africa a lot more, and people were waiting maybe for that. And fortunately for us, it didn't hit us that hard, or it hasn't hit us as hard as, you know, even South Africa is now coming out of it, and South Africa has been the most hit after, and Morocco. So I think there has been that combination. The second thing has just been, we have not, and I think Chiza said that, we have not told our story well enough. And my guess is that actually coming out of this crisis, that story is beginning to be told. I must say that, you know, when we had the finance ministers, and those of them who had market access said, you know, we value this and we want to do as much as we can to continue to do that, you know, that was for me a moment that said, you know, they're beginning to understand what good policy looks like. For me, I didn't read, I want to keep market access. I read, I want to keep good policies, as Charles was saying. I want to make sure that I continue to do well. And that's something that I need to do, market access or not, I want to keep doing well. And I think this is a speech that people are remembering Africa from HIPIC, from MDR, the Multilateral Debt Relief Initiative, MDRI. And so this was the last time Africa was in a big crisis, was MDRI, and everybody's expecting another MDRI, another HIPIC. And I think Africa is going to come out of this, hopefully not all of us, not 27 of us that went into HIPIC and MDRI, will go into a restructuring. There are going to be restructurings, and even maybe some of the countries that we think are doing well now will have to still go on the restructuring. But my sense is that that hopefully will begin to then allow us to demand, as Tijan said, a level playing field. Because I think there is still some consternation that Africa is demanding a level playing field. People don't understand, you know, why are they asking us to treat them like we're treating ourselves? You know, we have always treated them differently. And we're just saying, don't treat us differently, treat us like you're treating yourselves. Give us the stimulus, give us, you know, something that allows us to stand our economies now so we can build back better. And that for me, I think is going to be the big story of the post-crisis. But we shouldn't wait for that. Remember, we have climate change, and we have the whole disasters of climate change coming back. Ken has talked about the digital economy. We have the whole gender equity issues, global equity issues, I must say, since we're talking with the US audience, race and gender and everything else that we're going to have to deal with. And I think this question of a level playing field is going to come back in all of these discussions. I think that is what we're asking for now, is treat us, you know, give us the same kinds of access. And I think institutions like the Bank for International Settlements and the, you know, the Financial Stability Board, we're going to need to review and revise some of the rules that never took, you know, the emerging markets and Africa in particularly into account. So I hope that we can do that with this crisis, and that has come to the fore now, that there is need to change some of this global structures around which we sort of deal with public goods issues.
Thank you very much, Vera. That is a very inspiring set of comments on which we can bring this to closure. And I want to thank all of you, Minister Foriata, Tijani Tiam, Shedza Madima, Charles Robertson, all of you for being part of this conversation. I'm glad that we were able to focus on a little bit more specific set of issues around private sector and advance that conversation, I hope. Vera, thank you very much for your partnership in this. We are originally going to have a second panel, but Minister Foriata joined us for this, and so we've decided to compress that and have a longer panel, which we have just completed. Thank you all for participating, and we look forward to continuing this conversation in due course.
Thanks a lot, Masood. Thank you.
Thank you very much.
Thank you. Thanks, everybody. Thank you.